Well, thank you very much, Andrew, for that generous introduction. I am delighted to be here at this important forum today. And I suppose I see my role as the sort of warm-up act for the day. I want to try and set a framework for the more detailed discussions which will follow. Discussions about social finance in general, and as Andrew has suggested, social impact bonds in particular. And what I want to do from the beginning is to make sure that all of us in our room, because we come from different backgrounds and different perspectives, that all of us in this room understand what these bonds are. Understand them first as a new way of harnessing private sector finance. Understand them second as a means of contributing to beneficial social outcomes which are delivered by community enterprises. And third, to understand those bonds in terms of having positive value to government by lowering social disadvantage, tackling social exclusion, and of course, importantly and at the heart of this, reducing pressure on public expenditure. Now, on a good day when I'm out there really doing the spin, and I do, I say very boldly, this is a win-win-win. The bonds are a win for social enterprises, they are a win for government, and they're a win for the private sector. And I sort of believe that, as you will hear. Now, I could, of course, talk about social impact bonds in the United Kingdom, in Peterborough, of course, but also in a number of London boroughs and other cities and some of the county councils. I could talk about the emergence of what are called pay-for-success bonds in the United States, in New York City, of course, which is getting now quite a lot of coverage, but also in a small number of states and city municipalities. I could talk about the budget commitment just made by the federal government in Canada to introducing social benefit bonds. But what I want to do is to bring this, what I think is very significant ripple of activity, to focus here on New South Wales, to focus on the potential introduction of what here are called social benefit bonds. And as Andrew has said, I do so because I am the chair of the Social Investment Expert Advisory Group, working with Treasury, and therefore I suppose my knowledge of the opportunities and of the challenges is very much greater. And I'm going to focus on a couple of propositions which are now being looked at from proponents in New South Wales under active consideration, from a couple of not-for-profit organisations, the Benevolent Society and Uniting Care Burnside, which are sharing a belief that they can improve what is frankly the appalling state of childcare in many parts of New South Wales. The fact that the demand for out-of-home care through institutions of foster parents is significantly increasing. And these are two very entrepreneurial organisations that believe they can make a difference. So let's begin by looking at this potential for social benefit bonds from the perspective of each of those three sectors in New South Wales. Let's start by government, because in my view, it is very easy indeed to make a case why government can be a winner through the introduction of bonds. We know in New South Wales, as in other jurisdictions, there's increasing pressures on budgets as governments seek to balance their budgets in a time of significant economic volatility. We know that, as with many jurisdictions, there are rising infrastructure demands for roads, for rails, for ports, for a new convention centre, and at the same time, increasing costs of human service delivery, in health, in education, in disability, in justice. We know in particular that the costs of providing out-of-home care for children through institutions or foster parents have risen very steeply over the last 15 years. Partly because the number of children being assessed at risk has significantly increased, and because the cost of providing protection and care and support has become more expensive. And therefore there is clear advantage, as you can see, to a government, to the New South Wales government, in finding community organisations which believe that they can reduce the number of families having to give up custody of children, or even bolder, working with families whose children have been removed and helping them get into a situation where once again they have the capacity to look after their children. The advantage to government, of course, is that essentially it is transferring risk into the community sector, the risk of failure, because under these bonds it will pay only on the basis of outcomes, so that the Benevolent Society or Uniting Care Burnside obviously believe they can do this, and the New South Wales government is looking at a scheme whereby if they were successful, they could share the benefits of the cost savings that will accrue to government. As I say, a very clear advantage to government, I think, that the risk is effectively transferred across, that the government pays on performance, and you get, I think, a much more optimal allocation of resources through efficient pricing of risks. Real advantages. But why? Why would the Benevolent Society and Uniting Care Burnside want to take on those risks? Why would they be willing to become, if you like, third-party intermediaries for government? Well, they're here, they can talk to it themselves. So let me talk a little bit more in general about why social enterprises, not-for-profit community organisations are willing to do this. The one thing we know in the sector of social impact is that the demands always, but always, outstrip the resources that are available. And although you may have an entrepreneurial organisation and you think you know how to get beneficial social impact, you are always short of capital to do it. Put together all the philanthropy received and all the volunteering and the government grants, and nearly always you cannot expand your activities to the level at which you would wish in order to achieve positive results. And so bonds may provide an additional source of funding available to social enterprises so that they can scale up their enterprise and develop their capacity. And another real benefit, without the level of what is unnecessary government interference that usually accompanies the contracting out of government services to the not-for-profit sector. Because any of you working for organisations will know that even though you contract to deliver outcomes or outputs, it often comes with a high bureaucratic overload. The advantage of this is that once you effectively have signed the contract, it's up to you, the organisation, to deliver. You've taken the risks, but you've taken the responsibility. In other words, there is a much greater opportunity for entrepreneurial social enterprises to really innovate under this scheme. And the hope is that as a contract with government, you've got a prospective stream of income that can come in, and that stream of income can then attract investors who are willing to take a risk on your performance. So what you're essentially doing as the community organisation is not offering a repayment on a debt which you've incurred, We all know not-for-profit organisations struggle to get financial institutions to give them those loans. But rather you're offering the opportunity for individuals or institutions to hold quasi-equity in the enterprise. And here, I suppose in some ways, is the most important thing I can say today, particularly of those of you who have come out of the financial services sector. I've got to admit it, we got pay for success bonds, social benefit bonds, social impact bonds. The truth is, they're not bonds. And this is a bit of a challenge, but we do need to understand it. In other words, in a conventional sense, these social benefit bonds are not bonds at all. The issuing organisation isn't a government paying a fixed return or guaranteeing principal. The payments come from the social enterprises and are conditional on success. If you like, they're much more similar to a structured product or an equity investment. Which leads me third. I can see reasons why governments would like to do this. I can see reasons now why social enterprises. What about investors themselves? Why would they be willing to invest in this rather strange hybrid? Why would they welcome this new financial instrument in the market, which unusually offers not greater financial returns, but shared value opportunities? In other words, what it's trying to offer investors is part financial yield, yes, but also part social return. Now again, the good thing, this is not revolutionary. A whole lot's been happening in the social finance which helps to support bonds. We have seen the emergence of an increasingly significant class of socially responsible investors who do want to negative screen their investments and say, I don't want to put my money in companies that manufacture tobacco or involved in gambling or in uranium production, for example. So there is a potential market that is emerging. There are a range of individual and retail and institutional investors already willing to lend to small-scale startup entrepreneurs, especially in developing countries. You just got to think of the microcredit movement with which we associate the name Muhammad Yunus, or through an active social media website like Kiva that allows people to lend money via the internet. I went in and checked this morning, in the last week, 4,735 individuals have lent $2 million over the internet. So clearly there is a niche market that is already emerging that may have an interest. So, in the best of all possible worlds, this can be a win for the public sector, a win for the private sector, a win for the community sector. But, now let me be honest, it's not nearly as straightforward. And there are 4 major qualifications which I'm going to tell you about and then get out of the way while the panel discusses how to overcome them. First challenge is this, and Andrew has already said it. Social benefit bonds are not going to be a silver bullet. They're not a panacea. They're part of the evolution of a much wider panoply of social finance. They're part of a suite of new opportunities. They are complementary to, not an alternative to, existing forms of funding of social impact activities. The second qualification is, of course, that no matter how enthusiastically I extol the virtues of this new instrument, no one knows if investors will come. It's an unknown market. Information is scant. Risks are hard to assess. The tax treatment in Australia, unfortunately, remains uncertain. There is a lack of liquidity because there is a lack of a secondary market for bonds. Those are pretty significant challenges that need to be overcome. My view is, at least in the initial stages, it's likely to deter all but the most committed. It's likely, I think, that initial investors will be, if you will, sort of philanthro-capitalists. There will be people who are the socially responsible investors and philanthropists, people who would be willing, for example, to invest some of the resources in their private ancillary funds into these new bonds, or philanthropic foundations that might be willing to act as guarantees, or ethical investors. My view, there is a market there that will grow, but initially, and I could be wrong, and there may be others in the audience who disagree here, I don't think that we're going to be swamped by retail and institutional investors. People will need to know the market and understand it before they offer it more widely. The third thing that I want to emphasise, and again, Andrew touched it in passing, the third challenge is this. It's measurement. Now, I know measurement sounds really dull, but it is at the heart of whether bonds can succeed or not. We need to be able to identify clearly for contractual purposes performance measures and how outcomes are going to be assessed. And that's going to require quite sophisticated metrics. What outcomes and output information already exists, or the governments are actually going to now start to have to collect. What counterfactuals will be used against which performance can be benchmarked? How are you going to assess the potential impact of environmental externalities? For example, if you have entered a contract to reduce prisoners reoffending, reduce the rate of prisoner recidivism, how will you take into account what might be a change of law which has a significant impact on rates of incarceration? These are real challenges. I've got to tell you this, the good news that I have seen in New South Wales is whatever else comes out of this attempt to develop social benefit bonds, it is persuading governments and their public servants to measure impact, costs and benefits far more clearly and explicitly than has been done before. And that can only be a good thing. And the fourth challenge is this, it's political risk. And I'd have to say that I've become concerned that here in Australia, even before we got a bond up and running, if you like, the critical forces of opposition are starting to emerge, and not least in academic life. And there are two major political concerns that we need to be aware of with respect to these bonds. The first is this, that it's seen as appalling that banks or financial institutions or private investors might be seeking to make a profit, deriving financial return from social disadvantage. Now, I can argue this on rational grounds, but you can understand it has a strong emotional ring to it. And the second political challenge is this. It's argued that if these bonds are successful, then all that will happen is that governments will retire from the field, that governments will use bonds to reduce the level of public funding available to address social injustice and disadvantage. Now, here in New South Wales, the Premier, the Treasurer, the relevant ministers have all said very clearly that is not the case. But let us not be any doubt that in terms of political opposition, that is going to be one of the concerns that's raised. So, I've got no doubt that the panel that's going to now follow is going to discuss these issues. I look forward to listening, not least because I have no idea what the answers are. But here's my own cautiously optimistic conclusion. I do believe that performance-based contracting by government, and that in itself is increasing year by year, that performance-based contracting to the not-for-profit sector will, over time, increasingly take the form of bonds. And I think it's going to be particularly attractive where there is a long lag time, at least 3 to 5 years, between the incurring of the costs and the materialisation of outcomes. Now, obviously, out-of-home childcare is one of those issues. Prisoner recidivism is another. Potentially things like preschool education, or medical research, or social housing. Those areas of preventive investment where there is a long lag before you can measure outcomes are, in my view, particularly attractive to a bond approach. If, by contrast, you're contracting out in the short term, for example, through Job Services Australia, where you make payment on the basis of people getting into work for 13 or 26 weeks, I suspect that more traditional performance-based contracting is going to remain the norm. I believe too that the market will initially grow slowly, often funded by individual investors or quasi-philanthropists. But as market information and market certainty grows, as people are able to assess chances of success, as people are clearer about what is going to be the tax treatment of financial returns, then I think that retail and institutional investors will become more attractive. And of course, I see this already. In many areas now, these sort of funds are becoming mainstream. I sit on the board of AMP. We offer a sustainability fund. It is designed particularly for those socially responsible investors who want to take account of social impact as they place their money for financial returns. So you can see that there is already a basis on which investment in social benefit bonds could be based. And finally, I anticipate that some social enterprises will begin to contemplate offering impact bonds or charity bonds to investors on the basis of future streams of income without government getting involved at all. So that, for example, if you're undertaking medical research and as part of that there is a stream of income coming from people seeking medical services, you might be able to use that to offer a bond to the market, in which government isn't involved at all. And I can say, from my perspective, that could only be a good thing. So here's the bottom line. In my view, we need New South Wales and New York and Peterborough to succeed. We need it to succeed in order to increase the credibility of bonds as a part, but only as a part, of social finance. We do, in Andrew's words, I think need to make haste slowly. We need to learn by doing. We're not going to know all the answers in advance. We're going to have to manage prudently the risks of this new instrument. I think we've got to pick some winners. Nothing will be more disastrous, I think, in this area if governments would move too quickly, set up schemes that will collapse. What we need is some winners over time, gradually building momentum. That's what I'm hoping for. I think we can do it. And I hope, at least I leave you that with the idea that with all those challenges, I think this new instrument, being trialled in New South Wales and in which other governments in Australia are now starting to show increasing interest, that this new instrument is one of the most exciting and interesting games in town. Thanks.